Well, good afternoon if you're in the Eastern time zone of the United States or Central or Mountain time. Good morning if you're Pacific or in Alaska or Hawaii. Might even be happy Saturday if you're on the other side of the planet, because we wonderfully have an international audience here at the Fundraising School. I'm Bill Stanczykiewicz, one of the staff and faculty members of the Fundraising School and the Indiana University Lilly Family School of Philanthropy. And I'm so glad to welcome Mr. Holland to tell us about his opus. I always tell Phil Purcell, he reminds me of that great Richard Dreyfuss character. You must get that all the time.
You know, Bill, I've never heard that before. I don't even know what you're
Right.
talking about.
Yeah, exactly. So Phil Purcell is a longtime member of the Fundraising School faculty, and that doesn't even begin to describe what an invaluable resource he is across the fundraising profession. His fundraising has included higher education, large national organizations, secular, faith-based, with extensive background in legal issues, as well as in planned giving. And in fact, with our textbook, Achieving Excellence in Fundraising, we're so fortunate that Phil writes the chapter on legal issues. I know when I teach my undergraduate course, that is an assigned chapter so that the students can get a sense of the legal issues surrounding our profession. And we want to invite you as well. Phil and I are able to see ourselves here on this YouTube discussion, but we can't see you, and we also can't hear you. So what we're going to do is ask you to include your questions, your comments, your disagreements, your concerns in the comment section here on YouTube. Our colleague Jennifer Boffman will read those, and she will open up her mic and share those with Phil and I to comment on. Again, this first day from the Fundraising School is designed for you. You know, when the pandemic started and we went into lockdown, this feature started candidly to give fundraisers a chance to do a big primal scream and really react to what was going on. So share what's working for you. Share your concerns, share your ideas, commiserate with one another. That's what this next hour is intended to do. And Phil, along those lines, how was fundraising for you in the year 2020?
Well, 2020, like everybody, has been a challenging year, most particularly, of course, in the limited ability to see people face to face. You know, we all know that fundraising is a relationship-based activity. All of us who get attracted to fundraising as a profession, we tend to be people. Even the geeky, nerdy, planned giving crowd, we still, believe it or not, enjoy face-to-face meetings, conversations, looking people in the eye, reading body language, you know, all these other aspects of the art as well as the science of fundraising. So it's really challenged us, and I think everybody in this call will attest to that. That said, you know, we've found new ways, right? And like everybody else, Zoom technology has really stepped up and been so helpful in a host of different ways to help us stay in touch with people. And interestingly, even the now that I'm in the quote unquote boomer older generation, there's still some folks there, even older than I, who are out there actually logging in, you know, getting on the web. My mother-in-law, who's in her 80s, you know, she's right there on her computer. We talk and so forth. I must say, though, my 95-year-old mother is not wired, so to speak, this way. So there's still a lot of those from the World War II generation out there who maybe aren't quite at that level, but many are. In any event, I would say that our need to connect to them is balanced also by their need to be with us too. You know, so our finding these pathways to communicate often are reciprocated, and that's been helpful. And you know, I would say that that those loyal donors and supporters, benefactors of our organizations, they're aware. I have found they're aware of the needs of the problems facing charitable organizations, and so for those who are loyal, who are interested, the response has been good. And so we've had to alter the way we do it, but the results have, I've seen, still been strong and good, and but it's challenged us to change our style and strategy, and you know, sometimes the older we get, the less we want to change, let's say, or thinking about changing the way we do things, but for some of us, it's kept us young to keep after it this way. So challenging year, no doubt about it. Well, and that's not even getting into the whole issue, of course, of the budget strain that many charities are under. You know, some charities have had difficulty because of the decreased revenue, either through tuition revenue in school, university settings, or store revenue. If you're, say, a charity that has a thrift store or other revenue-based stream of income, you know, that's been tough. And or you're a charity that relies on gate revenue, the arts, as we know. You know, it's been horribly difficult. And so that's meant in some cases reductions in force, you know, and sometimes fundraising staff have been laid off. So it's we've seen the good and the bad, right, and the ugly, so to speak, all of it in the last year, and all so dramatically. You know, wow. You know, I had my last airplane trip was last February. I can't imagine. I've had a 30-year career year. I can't remember such a long stretch without getting on an airplane anywhere. And so, you know, that's it. There's been both good, bad, and ugly in all of this.
For those
And
of us, oh, go ahead.
well, and in the plan giving profession, those of us who work with folks in estate planning, especially elderly donors, we've experienced uh, folks who've gotten ill, who've passed away, and so a lot of sad moments too. I mean, we have those moments anyway in the course of a normal year, but this year I would say has been particularly poignant in that regard.
Yeah, and that has led actually to the survey results from the National Association of Charitable Gift Planners that I'd like to talk with you about before we conclude today, about nonprofits saying that there seems to be an increased interest amongst donors in making planned gifts with all the health and, yes, death news related to the pandemic. But on a much more attempt at a whimsical note, a couple of things. One, you mentioned, you know, not traveling as much. I traveled quite a bit before the pandemic, teaching for the fundraising school. It sort of reached that point late summer, early fall, where it's like, you know, I really don't need to go buy more toothpaste or anything else like that. I'll just use up what's in the travel bag, which isn't getting used. So I'll just go through all of that now before I
Yeah,
go to the grocery store and buy some more items. But just
yeah,
kind of one of those fun indicators of how life is different. My
yeah.
question for you: what's your favorite soft drink? Because I want to have a wager here. What's your favorite soft drink?
Well, right now it's Coke Zero.
Coke Zero.
Uh,
I'm a Coke Zero man myself, so this is going to be very easy to execute for when the pandemic's over, and unless we get within 7 feet of each other and chuck the can to the winner. If you had to bet, and it becomes an esoteric discussion now, kind of a bar stool discussion, um, but during the year, of course, it was very serious. But if you had to bet, do you think charitable giving in 2020 in total, when we get Giving USA in June, higher, lower, or the same as 2019, which, as you know, was the second best year ever, even after adjusting for inflation? As you're talking to colleagues, as you're doing your work, what do you think? What's your guess?
my guess is that overall it will be up. Um, I think my impression is, without the benefit, right, of any really national studies, just incidentals, things you read in Chronicle Philanthropy, other publications, and then what you experience in your day-to-day job and what you talk to colleagues about. You know, and a lot of that is due to some really large gifts that we're aware of, you know, by individuals who recognize the challenges that are there and the need by organizations to have resources to combat those challenges. And so you'd add it all up, and I would say it's up. And I'd like to think, and I also tend to think that even though the measuring of deferred gifts, we've not evolved to a point where we can measure um, deferred gifts where donors are still alive, but they've included a bequest. I think that may be up too, for some of the reasons you've alluded to, the increased attention to estate planning, you know, and unfortunately, a lot of people don't estate plan till they feel the necessity for whatever, something in their life triggers is a triggering event for them to think about putting together an estate plan. And sadly, this COVID experience has been a triggering event for that. And so we've had a lot of that going on. And yes, I've read the same articles indicating, and I've had the same experiences of perhaps an uptick in folks, not only estate planning, but including plan gifts. So not only cash on the barrelhead going up, I think estate plan gifts are likely up as well.
I remember when Giving USA came out last summer, Rick Dunham, who I know you know very well, and a national fundraising consultant, a good friend of our school at the time, was chair of the Giving Institute, which funds the Lilly Family School Philanthropy to produce Giving USA every year. He didn't guarantee, he didn't predict, he just said he would not be surprised if 2020 at least matched 2019. And our wager, I guess it's going to have to be null and void, because I'm with you. I think at the worst, we're going to break even compared to 2019. And that's just based only on anecdotal evidence, as we've taught for the fundraising school. I taught a course last week. We had nearly 100 participants over 4 days. And by far, they were saying their fundraising was up in 2020. And their
Mhm.
biggest concern was, in 2021, can I match what I did in 2020? Because 2020 was so strong. So I was like, wow, didn't think that was going to happen back in March and April. So
All right.
as we look ahead, then, Phil, what are you excited about fundraising in 2021? And what are you concerned about that we all can learn from as we do our own planning for this calendar year?
Well, right. Well, one thing I'm concerned about, and this might be more from my perspective, more globally, let's say, is, you know, when you have tough times, organizations have to make decisions sometimes. And while you and I might say we think gift results would be up, there will be organizations that had to make tough decisions. And I would argue sometimes they made the wrong tough decisions by paring back on their fundraising staff. There's a time to double down. And for me personally, of course, I'm a fundraiser. I believe this is the time to double down on fundraising. The time to get in a stock market is when it's down, and knowing that it'll come back up. Well, I look at fundraising the same way. This was a time to double down, go after it. And I'd say those organizations that were more reactive and pared back, they'll pay some unfortunately bad results of that, because they will not have, say, reaped the benefit of the folks wanting to help at this time. And then they're that much further behind as they go into 2021, because they don't have the staffing or the capacity to be more proactive moving forward. So that's kind of what I worry about, not so much the organization I'm with now, but with other organizations that have colleagues that I've talked to and so forth. And it is fascinating how people respond to stress or respond to the difficulty, and it's not easy to make hard decisions, I realize, but I'm biased. I'm a fundraiser. So this is a time I would have gone the other way on fundraising. So now on the upside, in terms of positive, I think we are, again, still in the crisis. Obviously, we're not out of it yet. So we continue to need to promote the needs of our organizations, and I think we will reap good benefit from that. Thankfully, we're not in the midst of a bad recession. And if there's one thing I've learned from Patrick Rooney and the gurus of economics at the Lilly School of Philanthropy, is that the one major correlative factor between gift giving and any other variable, it's the economy and the market. Market up, good; market down, not so good.
Right.
And so we've kind of fared well that way. I mean, it was really dicey there in 2020, but I'd say our market is, and endowment portfolios and so forth have held their own. And so that's a good thing. Giving from appreciated assets is always a very attractive thing. So we've got this economy here that's still favorable to good gift giving. And then we have, of course, the tax benefits that were made or extended and actually enhanced a little bit for 2021. The universal deduction, that we can, I can share details about if you like, but that's been extended and expanded. And that opens, tax benefits to even those who don't itemize, which is a great thing. And, maybe like the IRA rollover, it might even become something that we think would be a good idea for making it permanent in the law. How about that? And
Yeah.
that's my number one lobbying rally cry for everybody on this call is, let's make the universal deduction permanent in the tax code.
I want to talk about the federal government here in a moment, which is the main reason why we invited you today. I would say my own answer to that question, what concerns me most, certainly, of course, the millions and millions and millions of Americans and people worldwide who are still suffering economically
Yeah.
and sadly will continue to suffer economically. And my fear is, and I chair the development committee of our regional food bank, is as we hear the wonderful improvements in the economy that are very real, that they don't reach everybody, and we don't just so race ahead with the economic gains that we forget about the folks who are still struggling. And again, a lot of them are folks in the service industries, airlines, hotel, tourism, things of that nature. And we know, unlike other economic downturns, this time around, it is women who are more adversely affected by job loss than men. A lot of the sectors that are predominantly male, like construction, home building, home repair, are actually booming right now. It's some of those other sectors that are predominantly female that seem to be suffering the most. On the positive side, I don't know what's going to happen, but that's kind of why it's a positive. To me, it's very fascinating to see what's going to happen with digital. You mentioned digital last year. I don't, digital never goes backwards. Nobody's clamoring for their cassette tapes, from back in the day.
Well, now wait a
Uh,
minute.
yeah. So, I certainly we can't wait to get back in person, but I still think there's going to be that executive who's on your donor list who says, you know what, not lunch today. I really don't want to leave the office, the weather, the parking, whatever. Can we just do something over Zoom? Or, the person, and I'm just going to say maybe a parent who says, love the special event, but I got to find a babysitter and I got to go home and get my significant other and still get to the event and I still have to work the next day. Hey, remember last year when you just delivered a bottle of wine to my house and I got to do the event online? I'm going to be interested to see how much of that remains. I think we're going to be much more hybrid moving forward, while still the person to person will always be most interested. But anyway, we'll see. It'll be fascinating how it rolls out. And what we know now, Phil, and again, because of your expertise in planned giving, you are a legal expert for us here at the fundraising school. And now President Biden has been inaugurated. We now know that the Democrats control Congress, so the chairs have been reshuffled once again. What should fundraisers need to know? As you've heard about different policy proposals and different ideas floating around. Of course, an idea is one thing, a new law is another. But just kind of starting broadly, what's catching your attention as you think about federal policy changes prospectively and what that could mean for fundraising this year and into the future?
Yeah. Well, it's fascinating, now that I've been at this about 30 years to see how the attention paid to what Congress is doing and thinking has definitely ratcheted up over the course of my career. It's an interesting thing. A lot of the plan gift techniques we often talk about, like charitable remainder trusts and remainder interest and personal residence and farm and a variety charitable lead trust, are all creatures of the 1969 tax law. And, that, uh, I don't know all of the backstory in terms of what led to that 69 law, but I do know that after 1969, professional advisors, lawyers, nonprofit organizations, charities, and donors were slow to respond to the changes in the law. Now we're every day kind of what's going on, and that change happens. We immediately send a mailing out to our donors informing them of what the changes are. It's fascinating, but it was very slow, and I entered in the profession in the 80s, and it was the conversation was, we really need to start promoting these more and start doing it, and others like the endowment said, you really should. And so the endowment started doing some things to help jumpstart that kind of activity.
It only
And
been 15 years,
it had only been 15 years.
so I might as well
And,
get on board the train. Yeah,
well, exactly. And now we're trying to anticipate what's going to
yeah,
happen. And then once
great
it
point.
does happen, then we're sending our mailings out and doing it. And I would say that's all not a bad thing, or a very good thing. But by the same token, changes happen without a lot of forewarning. I mean, there are things brewing and then they pop out in a law. And as a professional, you're thinking, well, nobody ever said anything to me about that, or I never read anything about that. Where did that come from? So, for example, this universal deduction idea that
Mhm,
we now
mhm.
have. And I would say that's something that I hope will be getting attention but from the Biden administration in the terms of, as I said just a minute ago, of making it permanent in the law. And I am a big believer that we, all of us, have a duty to lobby for these kinds of positive changes. I really do think legislators hear us, and the more they hear, the better. Yes,
Before you move on, because there's a
yeah.
lot of good information here fundraisers need to know about the UCD and what could happen moving forward. Some nonprofits here are going to say, wait, I'm not allowed to lobby. And that's one of
Oh
those
yeah.
urban myths in our
Yeah.
sector. In case there's anybody with us
Yeah.
today, could you just clear that up
Yeah,
before you get back to
sure.
the UCD?
Yeah, great point. Well, look, there's a limit. All 501c3 organizations, except private foundations. Now, private foundations are 501c3 as well. So we often say 501c3, but what I mean, there are two cousins in the 501c3 world: public charities that have to either pass a public support test or they're exempt from the public support test, like churches. Those public charities versus private foundations like the Lilly Endowment, the Ford Foundation, the Gates Foundation, let's say. So they can't lobby at all, nor can they be involved in political campaign activity, advocacy for a candidate. Public charities, like probably most people on this call, I would imagine, maybe not all, but public charities can lobby. But the lobbying is limited. It cannot be substantial. And you might say, well, what is substantial? Well, there's no there are different ways to determine what is substantial. There is an actual election you can take called the 501H election, which creates for you a mathematical formula to calculate how much lobbying you can do. If you don't use the formula, then you're limited to this phrase or this word, insubstantial. You can only use insubstantial. Well, what does that mean? It means, well, if you add up all the money you spend on lobbying, wining and dining legislators, flying staff to Washington to walk the halls, and not just federal, but state as well, or even local, theoretically, walking the halls, putting together materials, trying, and lobbying in this context is defined as trying to influencing legislation. Uh, it's got to be insubstantial. Well, for larger organizations, that's still a fair amount of things you can do. You can do letter writing. You can send staff to walk the halls. You can have a lunch or two. There are things you can do to advocate for legislation, and it won't risk your status. If you start spending a lot of money on it, you better start being very cautious and talking to a professional about how much money you should spend, and you might consider that 501H election. Now, some 501c3s really want to get into it. Well, okay, if you really want to get into it, then another option is you create a separate 501c4 organization, kind of a brother-sister relationship, and this 501c4 can do even more lobbying, more than insubstantial. Yeah, a lot of options, depending on how much lobbying you want to do.
And of course, as a private citizen, I can go to the town hall meeting hosted by my congresswoman, town hall meeting hosted by my two senators. Bill Stan can write a letter to President Biden, and he's going to say, Bill, he contacted me. I know the president just can't wait to hear from me, right?
Yes,
as private citizens, we can advocate for whatever we want. Again, to be clear, we're talking about in our professional duties with our nonprofit. So, Phil, what is in place for the universal charitable deduction right now? And I know you said you hope maybe could it become permanent, could it become expanded in the future? But what do fundraisers need to know? What is available right now?
Yeah. Well, so what's available right now is if you're a single filer, you get a $300, what's called above the line deduction. And that means that regardless of whether you itemize on your tax return or not, you can claim that tax benefit. That above the line deduction reduces your adjusted gross income. And what's new this year is for a married couple filing jointly, that opportunity is $600. Last year it was just $300, regardless whether you're single or married filing jointly. This year they went the extra step to have $600 if you're a married couple filing jointly. So that's handy. The National Association of Charitable Gift Planners, NACGP, at their website, they're promoting a more aggressive kind of approach. Instead of $300 and $600, how about a few $1,000s? Above the line deduction. Of course, this is a This is an issue, literally. And you asked, well, what brews behind the scenes, so to speak? Well, for many years, well, let me back up a minute and say this, that this universal deduction for any taxpayer, regardless of whether they itemize, has been proposed for many years. It's been talked about, different ideas floated, shared, never used. But suddenly, CARES Act, the idea suddenly takes hold. So it's testament to the notion that if you got a good idea, just keep after it, because maybe time, in life everything's about timing, and we had the right timing here, and the universal deduction was available. The timing was also right because just 2 years prior passed the Tax Cuts and Jobs Act, which doubled the standard deduction. So what did that mean? That meant that most taxpayers would be claiming the standard deduction and not itemizing on their tax return. Well, to claim a charitable deduction, you have to itemize, unless you have this universal deduction, of course. But the itemized deductions are subject to a separate limit that I'll talk about in a minute. But because of this higher standard deduction, most taxpayers are using that. And the Lilly School had done an estimate of the decrease in the number of folks who would itemize and claim charitable deductions on their tax, quite a significant decrease. We'll see if that, I'm not sure, if there's really a resolution around whether that's a reduction of itemizers has reduced charitable giving or not. I imagine it may take a few years to get that figured out totally. But the point is that this universal deduction opens up tax benefit for philanthropy to large people. And we're lobbying to not only make it permanent, but let's up the dollar amount. Let's make it a couple thousand single person and 4,000 for married couples, or even higher, the 3,000 and 6,000, something
And,
like that.
and fun fact, you mentioned how a lot of planned giving vehicles were put into federal law in the 1969 Tax Act. Fun fact, that was the same tax act that created the minimum distribution payout for foundations, which now resides at 5. It wasn't 5 back then. It kind of fluctuated up and down. It wasn't until the 80s that it landed at 5. But here's a fun fact about the universal charitable deduction. This was part of federal law until the 1986 change in federal tax policy. And the UCD back then was 50 cents on the dollar. So there kind of was no limit. The limit was based on how much you donated. So, if you donated $10,000, your UCD was $5,000. So, there is history on this. It has been in place before. And for right now, again, fundraisers know the universal charitable deduction, 300 for a single, 600 for a married couple household. But Phil, as you mentioned, there's another wrinkle for this for the people who do itemize. And this is maybe for some of our higher income donors and our more major gift donors that fundraisers need to be aware of.
Yeah, we now have an itemized deduct. Well, if you do itemize on your tax return, there is a deduction limit, and it's stated as a percentage of your adjusted gross income, and and it varies depending upon what you give. So if you give cash versus stock or real estate, your deduction limit is different. And so what has happened in the CARES Act, the deduction limit was increased from 60% of adjusted gross income to 100% of adjusted gross income. And that higher deduction limit was extended into 2021. Now it expires. Like the universal deduction, the $300 to $600 I mentioned, this 100% deduction limit expires at the end of this calendar year. And while there may be good argument and good support perhaps for extending or making permanent the universal deduction, I would say it's unlikely perhaps that this higher deduction limit, this percentage, would be extended. But who knows? But in any event, 100% for cash gifts only. And those are cash gifts only to publicly supported charities, except for donor advised funds held by public supported charities. You cannot get a 100% deduction limit gift for cash gift to donor advised funds, private foundations, or supporting organizations. It's a whole nother conversation why the tax code tends to pick on donor advised funds. But the point is that it doesn't apply. But the real lesson for fundraisers on the call is this is a great year to promote people to maybe accelerate pledges they have with cash gifts. So if somebody's got a pledge written for your organization, they could accelerate it and pay it off this year with cash and then qualify for this 100%. Not only would the acceleration maybe mean that they would itemize on their tax return, because now all of their gifts are exceeding their standard deduction. But in addition to that, they're able to take the 100% deduction limit for all that cash giving. So 2021 is a great year to make big cash gifts, to accelerate pledges into this year to pay off the pledge, and again, to be able to itemize and take the big deduction.
That is fantastic advice. I had not heard that last point anywhere about the benefits to the donor for accelerating pledges. Phil, thank
Right.
you.
Uh-huh.
Thank you so much for that.
Uh-huh.
And again, but these are things in place for 2021. I will say, Chronicle Philanthropy just had a story this week that the kind of number one legislative interest in the among the independent sector and different organizations that lobby Congress directly is this extension and increase of the universal charitable deduction. And for folks who are joining us today, you might be for or against. This is not a policy or political meeting. We're just throwing information out there and how that could affect fundraising. This is a fundraising discussion just purely. And, Phil, another one of those ideas out there that both the president is talking about and, for example, Senator Wyden, who now will chair the key committee in the Senate side, that is the tax writing committee, are talking about changes to the capital gains tax. So as you've seen different ideas floated around, what do fundraisers need to know, about these ideas related to capital
Yeah,
gains?
it's hard to know where the dust will settle on that. So it's easy to speculate. I would say one lesson would be take your tax benefit when you can get it. So, okay, there's a lesson for 2021. Make a gift of appreciated property, not only maybe outright gifts, but this is where plan giving can help a lot, because with charitable remainder trust, for example, you can donate this appreciated asset to the charitable remainder trust. It sells the asset, escapes capital gains tax, and reinvests in a diversified portfolio that will earn the donor lifetime income. So there's some advantage there to save that capital gains tax at this 15% rate. You know, it's fascinating as one looks back on a career, because when I started, capital gain rate was at 28%, almost
Mhm.
twice what it is now. Well, of course, the capital gain rate now is tiered. The base rate is 15%, and which is probably the most commonly used, and scales up. But the base rate, or the rate, back in the 80s, 90s was 28%. So, but still, it confiscates a lot of wealth, and in terms of tax to Uncle Sam, and a lot of people have highly appreciated property, and they're kind of locked in. They've got it, and they wonder, well, though, if I sell it, I'm going to owe the gains tax. Okay, that's what you use for charitable. If you're going to make a gift anyway, consider the appreciated asset. Or if you're worried about giving too much away and not getting enough out of it for yourself or loved ones, well, consider a charitable remainder trust or a gift annuity that will pay yourself or loved ones the income while also either delaying or escaping the capital gain liability.
And you talk about property, for example, residential property is at near record levels, even after adjusting for inflation. And
Yeah.
that's purely driven by the pandemic as people look to buy houses, have more land. People who have the wealth to have a second home are moving out of the cities, out to the second homes out in the rural areas and small towns. And as you said, those appreciating assets, if you have donors in your portfolio, as Phil just said, that's a good conversation to have. And Phil, going back to something you had touched on earlier, is of course the stock market. And again, I always use a real simple example. I don't have your level of expertise, but if I bought a stock at $1 and now it's $10, when I sell, I have to pay capital gains on that $9 increase. Unless I donate the stock to Phil and his charity, then I deduct the 10 and don't have to pay the capital gains tax consistent with anything I might be eligible for. So again, we need to be talking to our donors about their stock holdings as well, right?
We do. This is an area where many fundraisers feel less than confident about saying something wrong um, or or misleading someone, especially if the donor is not sophisticated or elderly, let's say. And I never advise anybody to venture into territory they're uncomfortable with. And I do think it's good to be knowledgeable. By the same token, you can always plant these seeds and then encourage your prospects, your benefactors to talk to their advisors. You make it clear that you are not there to give them tax or investment advice, but these are ideas that help others. And you say to your prospects, we think this could help you too. And so talk to your advisors. So encourage them. But this issue of looking at assets other than the checkbook is awfully helpful to philanthropy. Because you think about the portfolio of what you own or what your prospects and donors would own. Well, 5-10% cash, for some people, maybe more, but their real estate, their retirement plan, life insurance, stock accounts, all that usually. And if they're a business owner, oh my gosh, anybody that it's in your portfolio owns a business, they need to be at the top of your list to talk to.
Say more
Because,
about that.
well, there's a lot of wonderful things about business owners. One is they have a lot of assets usually, and their business is an asset, and either however they own it is stock or LLC or whatever, as well as the not just the shares or ownership interest, but the assets within it, and that can get complicated, of course. But the point is that they've got these assets. Number two, they're often subject to tax and in a variety of ways. And so they're often always wired for thinking about ways to save tax. And the ultimate tax triggering event for the business owner is when they sell their business. And too often in the sale of a business, do these business owners think about philanthropy? Yeah, they may be very philanthropic people, but they get so enmeshed in the detail and the emotion and the strategy and all the detail of selling the business, they forget about how a gift of philanthropy is not only a wonderful thing to do, but it can save them a boatload of taxes. So it's either going to go to Uncle Sam or go to a charity. They're only going to get so much out of the sale of their business. And suddenly, but they often think of it too late. And they've already signed the sales agreement or they've already have this commitment. And that's too late sometimes to save that capital gains tax we talked about earlier. Rather, you need to plan the gift as you're planning the business sale and make a gift of some of the business shares to charity before the sale, then let charity sell to the buyer. And that way the seller, the donor, escapes both the capital gains tax and gets an income tax deduction. And suddenly they've sold the business. They got a bunch of cash from their sale of it, and they got big tax benefits by a portion of the business sale flowing through charity, getting them the tax benefit that reduces the tax on the part of the business they sold themselves. So, well, and then business owners tend to be planners, they're strategists. They love thinking about these things. So they're wonderful people to talk to about gift planning and the needs of your organizations. Now, sometimes they're entrepreneurial, right? So they'll tend to have opinions, and you might have to navigate or talk them down off of some opinions because they may want to tell you how to do your work, thinking they know better than you or your leadership, so forth. And that happens too, of course. We've all maybe had that experience. But the point is that they've got a lot of appreciated assets, and they also like to plan and can be very philanthropic. But getting their attention is the tough part of it.
And
Um,
again, some of these ideas out there about the capital gains tax would be restoring the rate back up to that 28%, as Phil mentioned, from back in history, or perhaps taxing capital gains at the person's individual personal income tax rate, which almost always is higher than the capital gains rate. Our school's research shows, and again, folks following us here today or watching the recording, you might be for or against that idea for lots of different reasons. We're just talking now in the context of fundraising. Our school's research shows that an increase in capital gains tax rates can lead to an increase in charitable giving because now that person is more likely to donate the stock to the charity as opposed to selling the stock. donate the appreciated land to the nonprofit as opposed to selling the
Yeah.
land. So
Yeah.
again, just kind of throwing that out there, just the math, just what the research shows.
Yeah, well, no doubt about it. I often refer to the 1990s as my Camelot years of fundraising. Why? We not only had the high 28% capital gain rate, but we had high growth appreciation both in land and stock. So there was a double whammy where people were locked into highly appreciated assets, but if they wanted to sell and diversify, they had to pay the high capital gain rate. So now you talk about musings in Congress and what makes you worried. For a while, there was discussion in Congress of doing away with um, the savings of capital gains tax on the gift of appreciated property. It's like, really? And or no deduction for gifts of appreciated property. It's kind of fascinating sets of conversations around all that. And from my point of view, these gifts of appreciated property, whether it's outright gifts of stock or real estate or whatever, both outright and into, like, say, life income plans like Term Mayor Trust, very important and valuable. So that, once again, that's where lobbying can be helpful to just make sure that those making decisions see all sides of what the effects of their legislation might look like.
Also discussions about the estate tax, kind of lowering the threshold of the dollars that could be not subject to tax. That number has crept up the last couple of federal tax bills. Now there's some talk about bringing that down again so that more of the dollars could be subject to taxation. Some of your thoughts again on what fundraisers need to know as those ideas are discussed in the coming week.
Yeah, well, again, wow, how dramatic the change has been with the estate tax. You use the word crept up. I would say more like um, put a nuclear powered engine on your backpack and blew it out of the stratosphere up, let's say. Because now, the estate tax is a worry to, I don't know what the half of 1% of the US population, whatever small amount the economists say it is. It's just not something that most fundraisers talk to donors about. Well, for the first 10, 15 years of my career, we're talking about a lot. I mean, the saving and well, there's always been my entire career a 100% estate tax charitable deduction. So we just had a conversation about the beauty of the 100% deduction limit for cash gifts to a charity. Well, for my entire career, including today, there is a 100% deduction for charitable gifts on the estate tax return. There's only two unlimited deductions in the estate tax code, and that's the charitable deduction and the marital deduction, what a surviving spouse will receive. And so, it's an attractive thing, but since so few people worry about it. Now, that said, we're talking about the federal estate tax. Interestingly, there are many states that have a state level estate tax at lower thresholds. So the conversation around saving estate tax can be very relevant for our friends in, let's say, the state of Washington or California, let's say, or Illinois, where they have, say, estate taxes that we have to worry about and that are at lower thresholds. I don't know. It's always been astonishing to me how that threshold has gone up, and the politics behind that decision making. But it is what it is, and it's very high now, and it's something that you would think would be fodder for coming down in this administrative or in the Biden and Democrat controlled Congress. But it was President Obama who signed the law to double the estate tax, some years ago, and it's been going up ever since. So, but we'll see. We'll see where that will go. But I would say that if that were to come down, that would be an attractive thing for fundraisers to talk to donors about.
Talking with Phil Purcell, I'm Bill Stanczykiewicz. This is the first day from the fundraising school. And again, we invite you to add your questions, comments, concerns in the chat session in the comment section on YouTube. And our colleague Jennifer Boffman will interject. She'll unmute and share those with us for Phil to address.
Bill,
Coming up
I
with
do have questions when you're ready.
Go right ahead.
Okay, so we've had several questions. The first one is the simple yes or no. Does the universal charitable deduction apply to gifts that were made in 2020? So the 300, 600 one?
I'm not sure I understand the question.
gift was made in 2020. Can I take the UCD now?
Well,
my
right. Yeah,
2020 return?
yeah. See, so you're filing your taxes this April, let's say, for 2020 calendar year. So in April 2021, you'll be filing your tax return for calendar year 2020. So the $300 universal deduction would be revealed only if you made the gift by December 31st of 2020. Could you claim a $300 universal deduction for calendar year 2020. Now what's going to happen for 2021, when you file your tax return in April 2022, reporting 2021, you can claim for a single person a $300 universal deduction or a $600 for a married couple filing jointly.
Perfect. Jennifer, what else?
Is there a specific spot in the tax code where some of these charitable information is spelled out, specifically the universal deduction or other areas that our fundraisers can easily find those?
Well, they're there. Whether you can easily find them or not, is
I actually went through. I channeled my inner Phil Purcell last December, and I cut and paste from the federal legislation that was signed at the end of December. So if you go on my Twitter account @_Bill Stan, follow me. I'll follow you back. You'll see the actual words from the legislation in my Twitter feed.
Good job, Bill.
But I'm sure there's something much more easier, Phil.
Everything we've talked about today, yes, is available. When you talk about where is the law, you've got what the Internal Revenue Code says, of course, and then you've got the Treasury regulations, and the regulations are there to implement the law too. So in any event, everything we've talked about is in the law. Finding it, this is part of what's more complicated is accessing the statutes. They're online. You can get most of this online, but knowing where to look and making sure you're reading the right thing, and making sure you're reading the most up-to-date language is kind of the trick. So I hope that helps.
Jennifer, what else?
What are you watching for in President Biden's stimulus plan that may impact fundraising?
Well, as I indicated, I definitely am hopeful that his stimulus plan will extend this universal deduction or make it permanent. I really hold out hope for that. I don't know, but I think that's a possibility. I don't know what Biden and his plan might do relative to the estate tax threshold, but if it comes down, there'd be opportunities for philanthropy from the estate planning standpoint as well, I would say, for good conversations with donors. Philanthropy gets a lot of money from bequests, but if you look at the Giving USA data every year, the bequest figure is always kind of the same, no big dramatic, percentage-wise. Now, the number may go up over time, but the percentage kind of hovers around 10% or whatever it is of all. It'd be great if that could pop up. And maybe a change to estate tax might do that. I don't know, but it'd definitely be a great conversation with those wealthier, high net worth donors. So at the annual fund level, it's trying to make permanent the universal deduction. I would think that could get some traction, but again, your lobbying would really help that. At the higher net worth donor level, it's this estate tax thing, and then whatever happens with the capital gains tax is a big deal, because that's, again, the capital gains tax issue is a really relevant piece for the higher net worth donors who have these appreciated assets to give away. Now, another thing we've not talked about is the importance of giving with the IRA charitable rollover and the bequests from retirement plans. This is huge. This is very important.
But before you get into that, I want to add a friendly amendment to your answer, and that is to be watching what happens with the stimulus checks. We know nonprofits saying that they were receiving $1,200 gifts kind of unsolicited when the first round came out in spring of 2020. Anecdotally, hearing the same thing happening with $300 and $600 gifts arriving with the stimulus that went out end of December, early January. The president talking about another round of $1,400 gifts intended, of course, for individuals and households that are struggling financially first and foremost.
All right.
Then we also know there are households, they still have their full-time jobs, still have their income, have fewer places to spend their disposable income, might just turn that $1,400 around into a charitable gift. As a fundraiser, we just want to encourage you, keep that information out there. Do it in a kind of a generic way, just through your communications and your donor communication. Look at who sent you a check for $1,200 last spring. Maybe there is a direct conversation with those individuals. But Phil, I would just add that's another thing the president is talking about that could have an effect on the base of the pyramid of fundraising moving forward.
Yeah, I think it's a great suggestion. I do want to put a plug in for everybody on the call to promote IRA rollovers, because these only apply to folks age 70 and a half and older. The required minimum distribution age was up to age 72 by the Secure Act a couple of years ago. But when they upped the required minimum age for distributions to 72, they did not up or increase the age for the IRA charitable rollover qualification. That remains at 70 and a half. And with this aging boomer population, this is right in the nub of my generation. And that's a big cohort right now. You know, I mean, a lot of attention is made to millennials, and that's rightly so. But my goodness, you've got to focus on gifts from the boomer generation. IRA rollovers are right in the nub of that. And the beauty of the rollover is it's not an income tax deduction tax savings. So you don't have to worry about whether they're an itemizer or not. It's kind of like the universal deduction. It's a tax savings giving opportunity without worrying about a tax deduction itemization scenario. So now there's a $100,000 limit per IRA, so you can get major gifts from it. And the logic is this. And now the RMD was waived for 2020, but it has not been waived for 2021. So these IRA folks have to take out a distribution in 2021. So the logic is this: I got to take the money out of the IRA anyway. I'm going to make a gift anyway. So why not use the IRA rollover? But they've got to send it directly to your charity. Now, once you get that IRA rollover, you keep that name on a list. Why? Because later you can have a conversation with them, now that you know they have an IRA, about a beneficiary designation of your gift for your charity from the IRA. So you're not just getting the apples off the tree, you got the opportunity for the tree, the remainder of what's left in that retirement plan at their death. That's a blended gift opportunity, both outright giving and deferred gift from the retirement plan. And it's the most tax-wise gift in the tax code, because if kids inherit it, they owe income tax on it. If you get it, they don't. And the Secure Act capped the number of years kids can get income off an IRA at 10 years. So there's a lot of incentive now to consider this kind of gift. Sorry, I had to make a plug.
No, and I was actually going to ask you about that. So I'm glad you brought that up. And I also want to make sure we get to the remaining questions that Jennifer has. And again, the money doesn't go from the retirement account to the individual to the nonprofit. You talk as a fundraiser to the individual. They get the designation forms from their retirement fund company, and then they write the information about the nonprofit. You will get the money from the company that holds the retirement fund. Jennifer, what else?
Well, I just want to let Phil know that Rose in our comment section says that the RMD, is a hidden gem, and they have lots of success using it. And Dr. Sarah Nathan would like to know, what ideas have you heard from nonprofits about promoting the UCD to constituents?
Well, doing it. I mean, website, letters, email blasts. You could do a little case study, 2 or 3 sentence kind of scenarios. It's just getting the word out. Letters, email blasts, website, talking to people, offering online webinars. Folks like to hear the latest and greatest. So you can even invite them into hey, here's the latest news on charitable giving and the latest news from our organization, or maybe you flip that, but and invite them into a room like this, a Zoom room, and talk about these things. I would use every means at my disposal to just put this prompt out there. Put it in your annual fund mailings. PS, as we all know, they read the introduction, they go right to the PS. Put it in the PS. That kind of thing to get the word out.
Really providing donor service. So it can be part of a direct ask, and it can be just part of positioning your nonprofit, just keeping the general public, including donors, aware. Jennifer, I'm mindful of the time here. Do we have any more questions to address to Phil before we conclude?
We do not. He took care of
All
all
right.
of them. Thank you.
Phil, last piece of advice. Let's shift gears to plan giving. Since we have you here, what advice do you have for fundraisers in 2021 as they're thinking about prospects for plan giving?
Hey, it's still January. People are thinking about their New Year's resolution. I think the New Year's resolution for 2021, either if you don't have an estate plan, and the odds are great that 60% of your benefactors do not have an estate plan, this is the year to do an estate plan. And you know what? You got to have an estate plan usually to have the biggest possible impactful planned gift. So the advice is encourage your benefactors to, as a New Year's resolution, to do themselves a favor and create an estate plan. And if they already have an estate plan, again, the odds are great it's out of date, or update their estate plan. And in doing that, consider to make the most meaningful gift they could ever make to a charity by including your charity or other charities too, if they want, in that estate plan with a planned gift. That would be my advice for 2021.
And the advice that I would add on to that is remember, you as fundraisers are always in the relationship business. I know some of what was covered today, nuclear head emoji, we get that. Your responsibility is the relationship with the donor. If continue to get professional development. We have a plan giving course at the fundraising school. There are other places you can learn and gain the technical expertise. You're in the relationship business. If the discussion goes beyond your technical expertise, this is why we recruit technical experts to our boards of directors, lawyers, accountants, people who are financial managers who we can turn to. When we hire our bank, we have these conversations. Can you help us if somebody were to donate a stock? When we recruit a law firm to do our nonprofits legal work, hey, if somebody starts talking to us about trusts and annuities and things, our local community foundations, just about every county in America, either directly or with several other counties is served by a community foundation. They have expertise. There's places you can go for the technical expertise while you sharpen your own portfolio of knowledge. In the meantime, maintain those strong relationships. Phil Purcell is a cherished member of our faculty here at the fundraising school, where our public courses continue in person in Indianapolis. That's this photo behind me here. And we're also looking to expand potentially to 4 more cities in the second half of 2021, as long as the health and economic conditions allow us to do so. And so stay tuned for that. In the meantime, our courses are also available online, either asynchronous, meaning recorded, or synchronous, meaning live, and you can still apply for a crisis response scholarship, 50% off the price of registration. We have our free podcast next Monday, kind of the latest in digital fundraising with Justin Ware. So you don't want to miss that next Monday. This week, Una Osili, predictions on fundraising for 2021. You can't miss this. It's a free resource every Monday. What do we have? We have a webinar coming up in February on board engagement with fundraising, some new research that can help you get your board more engaged. And of course, Fridays with the fundraising school. All of this online at philanthropy.iupui.edu/the fundraising school. With Phil Purcell and Jennifer Boffman, I'm Bill Stanczykiewicz. Great to have you with us. Have an awesome weekend. Make sure you stay in touch. And do 2 things. We all believe in the philanthropic sector, that we have the audacity to believe that we can make the world a better place. So number 1, you go make the world a better place. Number 2, let us know how we can help. We'll see you when we see you. Take care.
Okay, we're done.